Have you ever wondered why some people with modest incomes end up wealthy, while others with huge salaries struggle to save? Why do smart people sometimes make terrible financial decisions, and what's really behind the way we think and act about money? Today, we're diving into the secret rules of wealth that no one teaches you in school, but that shape your life every single day. Welcome to your own channel, Unbound Library. If you find value in thoughtful book summaries and want to grow wiser with your money and life, make sure to hit that subscribe button and turn on notifications so you never miss an episode. Before we begin, a quick heads up. What you're about to hear is a detailed summary of The Psychology of Money by Morgan Housel. This audio is meant to give you the key insights and lessons from the book, but nothing can replace the experience of reading the full book yourself. I highly recommend getting your own copy, because the stories, research, and wisdom inside are truly worth your time. Let's get started. Introduction. The Psychology of Money by Morgan Housel. Money is everywhere in our lives, yet most of us don't stop to think about why we behave the way we do with it. In the introduction of The Psychology of Money, Morgan Housel invites readers to look beyond spreadsheets and formulas. He wants us to see that financial success isn't just about what you know. It's deeply tied to how you behave. Housel opens by emphasizing that managing money is not a hard science. It's a soft skill, shaped by emotions, habits, and unique personal experiences. As he puts it, doing well with money has little to do with how smart you are, and a lot to do with how you behave. This sets the tone for the entire book, challenging the notion that intelligence or professional expertise guarantee good financial decisions. He shares that his years as a financial journalist showed him a simple truth. People from all backgrounds, rich or poor, educated or not, often make the same money mistakes. Everyone has stories about fear, greed, luck, and risk. Housel believes that understanding these patterns is the real key to financial well-being. The introduction also highlights why stories matter more than statistics. Housel notes that we learn best from relatable examples rather than abstract data. He explains, "We all think we know how the world works, but everyone sees the world through their own unique lens. What shapes that lens? Our childhoods, our parents' attitudes about money, our own moments of triumph and regret." Housel promises readers that this book isn't about quick investment tips or get-rich-quick schemes. Instead, he wants to change how we think about money, how we react to it, worry about it, and use it to shape our lives. He encourages us to be honest with ourselves and to recognize our blind spots and biases. To close the introduction, Morgan Housel assures us that the psychology of money will take us through timeless lessons, drawn from history, psychology, and real-life examples. He hopes that by understanding the hidden forces behind our decisions, we can make smarter choices and find more peace in our financial lives. From the start, Housel's voice is relatable and clear. He wants every reader, busy professionals, parents, young adults, and retirees, to feel understood and empowered. The journey ahead isn't just about growing wealth, it's about understanding ourselves. Chapter 1. No One's Crazy. Morgan Housel opens the first chapter of The Psychology of Money with a simple but profound idea. When it comes to money, no one is crazy. Each person's financial decisions might look odd from the outside, but those choices make sense through the lens of their unique life experiences. Housel explains that everyone grows up in different circumstances. Some people see their parents struggle during a recession, while others grow up during periods of economic boom. These early memories shape our deepest beliefs about money, even if we're not aware of it. As Housel says, your personal experiences with money make up maybe 0.0001% of what's happened in the world, but maybe 80% of how you think the world works. He uses the story of two investors to show how different backgrounds shape our views. One is a man who grew up during the Great Depression and avoided risk his entire life. The other is a tech entrepreneur who became wealthy in the late 90s and saw risk as an opportunity. Both make decisions that seem rational to themselves, and both are shaped by the times and circumstances they lived through. Housel stresses that judgment is easy from the outside. We might look at someone's spending or investment choices and think they're irrational or foolish. But as he gently reminds us, people do crazy things with money, but no one is crazy. What looks like an error may be a survival strategy learned long ago. To illustrate, Housel shares stories from history. People who avoided banks after losing everything in a financial crisis, or those who saw wild success by taking chances others wouldn't risk. He points out that our attitudes towards saving, spending, and investing are built on personal histories, news headlines we remember, and stories we hear from family and friends. A key takeaway from this chapter is empathy. Housel urges readers to recognize that everyone has their reasons for acting the way they do. Instead of judging others or ourselves too harshly, he suggests we try to understand the stories behind the choices. He closes the chapter with a message about humility. We are all guessing about the future, reacting to what we know, and hoping for the best. By accepting that no one is truly crazy with money, we open ourselves to learning from others and making better decisions ourselves. Quote to remember, your experiences make up maybe 0.001% of what's happened in the world, but maybe 80% of how you think it works. Morgan Housel. Chapter 2. Luck and Risk. In this chapter, Morgan Housel explores two forces that shape every financial outcome: luck and risk. He argues that while we often believe success and failure are the results of hard work and smart choices, the reality is far more complicated. Housel starts by telling the story of Bill Gates. Gates became one of the world's richest people after founding Microsoft, but Housel points out a remarkable fact. Gates attended one of the only high schools in America that had a computer in 1968. This rare opportunity shaped Gates's future. As Housel writes, luck and risk are both the reality that every outcome in life is guided by forces other than individual effort. But luck doesn't just work for us. It can work against us too, in the form of risk. Housel uses the example of Kent Evans, a childhood friend of Gates, who was just as talented, but who died in a mountaineering accident before he could achieve success. The difference between Gates and Evans wasn't talent or ambition, but luck and risk. Housel emphasizes that while we admire successful people and try to copy their habits, we often overlook the role luck played in their journeys. Likewise, we may judge those who fail without realizing how risk affected their lives. He writes, "Not all success is due to hard work, and not all poverty is due to laziness. Keep this in mind when judging people, including yourself." The author encourages humility when making judgments about ourselves and others. He suggests that being aware of luck and risk helps us avoid arrogance when things go well, and despair when they don't. Instead of seeing outcomes as simple reflections of effort or intelligence, we should view them as part of a complex web of chance. Another lesson from this chapter is the importance of focusing on broad patterns rather than individual stories. Housel notes that it's useful to look for general behaviors that lead to good outcomes over time, rather than copying every detail of a successful person's life. He ends with practical advice. Be careful when taking lessons from extreme outcomes, both good and bad. Learn from many people and many situations, not just outliers. Quote to remember: "Not all success is due to hard work, and not all poverty is due to laziness. Keep this in mind when judging people, including yourself." Morgan Housel. If you're finding these insights helpful, don't forget to subscribe to Unbound Library and click the bell icon so you never miss the next chapter. Chapter 3. Never Enough. In this chapter, Morgan Housel examines the idea of enough and how our inability to recognize it can lead to financial trouble, stress, and even disaster. He argues that knowing when you have enough is one of the rarest and most important financial skills. Housel opens with the story of Rajat Gupta, a successful businessman who had everything: wealth, status, and respect. But it wasn't enough. Gupta got involved in insider trading to gain even more, risking everything he'd built. Housel contrasts this with the story of a janitor named Ronald Reed, who lived simply and quietly amassed millions through decades of careful investing. Unlike Gupta, Reed knew what was enough for him. The author explains that the pursuit of more money, more status, more possessions, often leads people into dangerous territory. There is no reason to risk what you have and need for what you don't have and don't need, Housel writes. The desire for more can blind us to the risks we're taking and the happiness we may already have. Housel points out that social comparison fuels this problem. We tend to measure our success against others, even though their circumstances or values may be completely different from ours. This constant comparison creates a moving target. No matter how much we achieve, there's always someone who has more. He reminds the reader that happiness is not found in constant accumulation, but in contentment. Recognizing enough is about setting boundaries and defining what matters most. Housel suggests asking ourselves what we're willing to risk and what we're not. Most importantly, he urges us to separate our self-worth from our net worth. The chapter also includes stories of lottery winners who end up unhappy or bankrupt, and business people who lost fortunes by always chasing more. The lesson is clear. Contentment is a superpower in a world obsessed with more. To conclude, Housel encourages readers to practice gratitude and restrain. The goal is not just financial security, but peace of mind. Quote to remember, "There is no reason to risk what you have and need for what you don't have and don't need." Morgan Housel. Chapter 4. Confounding, Compounding. Morgan Housel opens this chapter by spotlighting what he calls the most powerful force in finance: compounding. He explains that while the concept is simple, its effects are so extraordinary that most people dramatically underestimate its potential. Housel uses the example of Warren Buffett to illustrate his point. Buffett is one of the richest people on earth, but Housel notes that much of his wealth came not just from high investment returns, but from starting early and staying invested for an incredibly long time. Buffett began investing as a child and continued into his 90s. His real secret is time, Housel notes. That's how compounding works. This is the magic of compounding. Small, consistent gains over a long period can lead to results that seem impossible at first. Housel refers to this as confounding compounding, because the human mind struggles to grasp how much can be achieved through patience and consistency. To drive this home, Housel shares stories of people who chase quick wins or try to time the market, only to fall short compared to those who simply let their investments grow. He points out that compounding applies not just to money, but also to knowledge, relationships, and habits. The longer you stick with something good, the greater the benefit. Housel warns against impatience. Many people give up too soon because early gains appear small and progress feels slow. But the real rewards come later, when compounding accelerates. He writes, "Good investing isn't necessarily about earning the highest returns. It's about earning pretty good returns that you can stick with for a long period of time." He encourages readers to think long-term and resist the temptation to change course based on short-term results. Consistency beats brilliance when it comes to building wealth. The chapter closes with practical advice. Focus on time, patience, and steady growth rather than chasing big wins. Compounding is most powerful for those who respect its slow, quiet nature. Quote to remember, "Good investing isn't necessarily about earning the highest returns. It's about earning pretty good returns that you can stick with for a long period of time." Morgan Housel. If you're finding these insights helpful, don't forget to subscribe to Unbound Library and click the bell icon so you never miss the next chapter. Chapter 5. Getting Wealthy versus Staying Wealthy. Morgan Housel starts this chapter by highlighting a crucial difference. The skills and mindset needed to get wealthy are not the same as those required to stay wealthy. Many people can make a fortune, but far fewer manage to keep it over the long run. Housel explains that getting wealthy often involves boldness, optimism, and taking calculated risks. Entrepreneurs, investors, and business people who succeed usually do so by believing in themselves and seizing opportunities others ignore. But once wealth is achieved, the priorities shift. Now, the key becomes preservation, protecting what you have through humility, caution, and a healthy respect for risk. He illustrates this with real-life stories. One example is Jesse Livermore, a legendary stock trader who made and lost several fortunes because he couldn't stop chasing big wins. In contrast, Housel points to people who quietly maintain their wealth by being careful, planning for uncertainty, and never assuming good times will last forever. Housel emphasizes that luck and risk are always present. It's easy to mistake a lucky streak for skill or to forget how quickly circumstances can change. He writes, "Getting money requires taking risks, being optimistic, and putting yourself out there. But keeping money requires the opposite, humility, and fear that what you've made can be taken away from you just as fast." One of the main takeaways is the importance of survival. Housel argues that avoiding ruin is the single most important factor in staying wealthy. He encourages readers to plan for setbacks, prioritize financial security, and avoid making bets that could wipe them out. Housel also advises against arrogance. Wealth can create a sense of invincibility, but history is full of examples where overconfidence led to disaster. He recommends focusing on endurance, lasting through ups and downs, rather than maximizing gains at all costs. The chapter ends with the reminder that wealth is fragile. Protecting it requires humility, patience, and an understanding that the future is always uncertain. Quote to remember: "Getting money requires taking risks, but keeping money requires the opposite, humility, and fear that what you've made can be taken away from you just as fast." Morgan Housel. Chapter 6. Tails, You Win. Morgan Housel explores a fascinating truth in this chapter. A small number of events often account for the majority of outcomes, especially in finance. These rare, powerful events are called tail events, and they can change everything. Housel introduces the idea by explaining that in many areas of life, most things don't matter much, but a few things matter a lot. In investing, these rare tails are the extreme wins or losses that can determine the entire result of a portfolio. He writes, "Anything that is huge, profitable, famous, or influential is the result of a tail event. An outlier, one in thousands or millions." He uses the example of venture capital investors who understand that most of their investments will fail or only break even. But a single big winner, a tail event, can more than make up for all the losses. The same pattern appears in stock markets, business successes, and even in personal lives. Housel points out that Warren Buffett made the vast majority of his wealth from only a handful of investments out of hundreds. Housel encourages readers not to be discouraged by failure or setbacks. It's normal for most attempts to yield modest or even disappointing results. What matters is staying in the game long enough to catch a tail event when it comes. He writes, "You can be wrong half the time and still make a fortune if the things you're right about are big enough." Another key point is not to judge yourself too harshly for mistakes or average results. Most people don't see the behind-the-scenes failures that lead up to success. Housel suggests focusing on big-picture trends and being ready for rare opportunities rather than obsessing over day-to-day performance. He also warns against expecting life or investing to be fair or balanced. The world runs on outliers, unexpected wins and losses that can't be predicted. The chapter closes with practical advice. Be patient, stay diversified, and give yourself as many chances as possible to benefit from tail events. Success often means surviving long enough for good luck to find you. Quote to remember: "You can be wrong half the time and still make a fortune if the things you're right about are big enough." Morgan Housel. If you're finding these insights helpful, don't forget to subscribe to Unbound Library and click the bell icon so you never miss the next chapter. Chapter 7. Freedom. Morgan Housel uses this chapter to highlight what he believes is the single most valuable form of wealth: freedom. He argues that beyond money or possessions, the ability to control your time and make your own choices is the ultimate goal of financial success. Housel opens with a simple but powerful observation. People often think of wealth in terms of things, houses, cars, luxury. But when he asks people what they really want out of life, the answer is almost always some version of control over their day. Controlling your time, Housel writes, is the highest dividend money pays. He provides examples from real life. There are stories of people who earn huge incomes but feel trapped by demanding jobs and schedules. In contrast, others with more modest means feel rich because they can spend their days as they wish, picking up their kids from school, pursuing hobbies, or simply doing nothing at all. Housel explains that the freedom to wake up and do what you want, when you want, with whom you want, for as long as you want, is rare and precious. He encourages readers to measure wealth not just by how much money they have, but by how much control they have over their time. He acknowledges that achieving this freedom isn't easy. It often means making trade-offs, sometimes earning less, spending less, or saying no to opportunities that would reduce your autonomy. But Housel argues that these trade-offs are often worth it for the peace of mind and satisfaction that come from true independence. The chapter also touches on the dangers of chasing status and approval from others. Housel warns that letting other people's expectations dictate your choices can quickly erode your sense of freedom. He urges readers to define success on their own terms. To end the chapter, Housel reminds us that financial decisions should ultimately serve our lives, not the other way around. The real measure of wealth is how much control you have over your time and your choices. You owe it to remember, quote to remember. Controlling your time is the highest dividend money pays. Morgan Housel, Chapter 8, Man in the Car Paradox. Morgan Housel opens this chapter by describing a common scene: someone driving an expensive car down the street. Most people think that onlookers are admiring the driver, imagining themselves in that car with that status. But Housel points out a surprising truth. People don't actually admire the driver. They imagine themselves behind the wheel. This is the man in the car paradox. As Housel puts it, no one is impressed with your possessions as much as you are. The admiration we hope for rarely materializes. Instead, observers are thinking about what it would feel like for them to have that car, that house, or that lifestyle. They don't think about you at all. He tells stories of people who spend fortunes trying to impress others, believing it will bring them respect or admiration. But most people are too busy thinking about their own lives to notice yours for long. Housel writes, "We often judge wealth by what we see, because that's all we can see. But real wealth is what you don't see." Housel emphasizes that true wealth is invisible. It's the savings, investments, and choices that don't grab attention, but create peace of mind and security. He cautions against spending money just to signal status. The quest for recognition through possessions is a losing game because the admiration is fleeting or even non-existent. He shares the idea that the people we try to impress are usually focused on their own goals and worries. Spending to impress often leaves us less secure and further away from real freedom. The chapter closes with practical advice. Focus on building real wealth, not just the image of wealth. Invest in things that make your life better, not just those that signal success to others. Quote to remember: "No one is impressed with your possessions as much as you are." Morgan Housel. If you're finding these insights helpful, don't forget to subscribe to Unbound Library and click the bell icon so you never miss the next chapter. Chapter 9. Wealth is what you don't see. Morgan Housel begins this chapter by challenging the common idea that wealth is measured by what we can see. Big houses, fancy cars, designer clothes. He argues that true wealth is actually invisible. It's about the money that isn't spent, the investments that quietly grow, and the financial security that comes from restraint. Housel explains, "Wealth is what you don't see. It's the cars not purchased, the diamonds not bought, the renovations postponed, the clothes forgone." Most people focus on visible signs of success, but those are usually signs of spending, not saving. The things we admire in others are often just the result of money leaving their bank accounts. He illustrates this with stories of people who look rich, but are actually deeply in debt, and others who live modestly while accumulating significant assets. Housel stresses that saving money doesn't feel as rewarding in the short term as spending it, because there's nothing flashy to show for it. But over time, savings are what enable freedom and opportunity. The chapter explores why people fall into the trap of spending to signal wealth. Social pressures and a desire for approval drive many to prioritize appearances over real financial health. Housel warns that this can lead to a cycle of living paycheck to paycheck, even for high earners. Instead, he encourages readers to embrace the quiet power of saving. Building wealth is less about what you earn and more about what you keep. He writes, Spending money to show people how much money you have is the fastest way to have less money. Housel also touches on the importance of delayed gratification. True wealth comes from making choices today that benefit you tomorrow. This requires discipline and a willingness to let go of the need for immediate recognition. He closes the chapter by urging readers to shift their mindset. Focus less on impressing others and more on building a secure future for yourself and your loved ones. Quote to remember: spending money to show people how much money you have is the fastest way to have less money. Morgan Housel. Chapter 10. Save Money. Morgan Housel dedicates this chapter to a principle that seems simple but is powerful. Save money. He argues that while investing, earning, and growing wealth are important, nothing compares to the foundational strength of simply saving. Housel explains that saving is not about depriving yourself or living in fear. Instead, it's about creating options and flexibility. He writes, "Building wealth has little to do with your income or investment returns, and lots to do with your savings rate. Saving gives you the ability to weather unexpected events, take advantage of opportunities, and live life on your own terms." He points out that many people focus on earning more or chasing higher investment returns, but overlook the power of saving. Even with a modest income, consistent saving can lead to financial freedom over time. Housel shares examples of people who became financially secure not because they earned massive salaries, but because they controlled their spending and prioritized saving. The chapter explores why saving is so effective. Unlike investment returns, which are never guaranteed, saving is always within your control. It doesn't depend on the stock market, the economy, or external circumstances. Housel notes that personal savings and frugality, finances conservation and efficiency, are more in your control and have a 100% chance of being as effective in the future as they are today. Housel also discusses the psychological side of saving. Saving money can bring a sense of security and peace, knowing you are prepared for whatever comes next. It builds confidence, reduces anxiety, and gives you the freedom to make better decisions. He cautions against the temptation to increase spending every time your income rises, a common trap that prevents people from getting ahead. Instead, Housel encourages maintaining a gap between what you earn and what you spend. The chapter ends with practical advice. Start saving today, no matter how small the amount. Over time, even modest savings grow into real wealth. The key is consistency, discipline, and a focus on the long-term benefits of financial security. Quote to remember: building wealth has little to do with your income or investment returns, and lots to do with your savings rate. Morgan Housel. If you're finding these insights helpful, don't forget to subscribe to Unbound Library and click the bell icon so you never miss the next chapter. Chapter 11. Reasonable Rational. Morgan Housel opens this chapter by addressing a common misconception in personal finance, that people should always act rationally with their money. He argues that being reasonable, making choices that align with your values, emotions, and real life, is often more important than being purely rational. Housel explains that traditional financial advice is rooted in logic and math. It assumes we'll always choose the option with the best expected return. But in reality, people are influenced by hopes, fears, family, and comfort. A rational investor makes decisions based on numbers, Housel writes. A reasonable investor makes decisions based on their own goals and peace of mind. He shares examples of people who hold on to cash even when the market says they shouldn't, because it helps them sleep at night. Others pay off low-interest mortgages early, even though investing the money might bring higher returns. These choices aren't perfectly rational, but they're reasonable if they reduce stress or align with personal values. Housel argues that financial success isn't just about maximizing wealth, it's about living the life you want without constant anxiety. He encourages readers to acknowledge their emotional needs and to make space for them in their financial plans. Being too rigid or logical can backfire if it leads to decisions you can't stick with or that make you miserable. He also points out that being reasonable helps you stick with your plan over time. If your strategy is too uncomfortable or demanding, you're likely to abandon it at the worst possible moment. In contrast, a reasonable approach is sustainable because it fits your personality and circumstances. Housel emphasizes that there's no one-size-fits-all answer in personal finance. What matters is finding a balance between logic and emotion that lets you make good decisions and sleep well at night. He wraps up the chapter by urging readers to be honest with themselves about what really works for them, not just what looks best on paper. Quote to remember: a rational investor makes decisions based on numbers. A reasonable investor makes decisions based on their own goals and peace of mind. Morgan Housel. Chapter 12. Surprise. Morgan Housel begins this chapter by reminding us that the world is full of surprises, especially when it comes to money. The future is unpredictable, and almost every major financial event, good or bad, catches most people off guard. Housel argues that being aware of surprises and building flexibility into your financial plans is critical for long-term success. He shares that history is often viewed as a series of predictable trends, but in reality, it's shaped by unexpected events. Housel writes, "History is the study of change, ironically used as a map of the future." Most of what shapes our world, including recessions, booms, or technological breakthroughs, comes from things no one saw coming. He gives examples such as the financial crisis of 2008 or the rise of the internet. These were not widely forecasted, and yet they had massive impacts on people's lives and fortunes. Housel points out that even experts are frequently wrong about what will happen next. Because surprises are inevitable, Housel suggests adopting a mindset of humility and preparation. He recommends creating financial plans that are robust enough to handle the unexpected. This means having savings, keeping debt low, and not relying on any single prediction or scenario. He also discusses the emotional reactions to surprises, fear during downturns and greed during booms, and how these emotions can lead to poor decisions. Housel stresses the importance of expecting the unexpected and not getting overconfident when things are going well. Another lesson from this chapter is to avoid building your entire strategy around a single forecast. Instead, be flexible, diversify your risks, and leave room for error. This approach will help you survive and thrive no matter what surprises come your way. Housel ends the chapter with a call for adaptability. Accept that surprises will happen and focus on being prepared rather than trying to predict every outcome. Quote to remember: "History is the study of change, ironically used as a map of the future." Morgan Housel. If you're finding these insights helpful, don't forget to subscribe to Unbound Library and click the bell icon so you never miss the next chapter. Chapter 13. Room for Error. Morgan Housel emphasizes in this chapter that room for error is one of the most important yet underrated principles in personal finance. He explains that no matter how confident we are in our plans or predictions, the future always carries uncertainty. Building a margin of safety into your financial decisions is essential for lasting success. Housel begins by comparing finance to engineering. Engineers design bridges to hold much more weight than they're expected to bear, just in case. Similarly, we should build financial lives that can withstand shocks, job losses, medical emergencies, market downturns, or unexpected expenses. He writes, "The most important part of every plan is planning on your plan not going according to plan." This approach is not about pessimism. It's about realism and humility. Even the smartest people can be caught off guard by events outside their control. Housel shares stories of investors and business leaders who survived tough times simply because they were conservative in their assumptions and always kept a safety net. He points out that having room for error isn't just about money. It's also about emotional resilience. If your plans are too rigid, you're more likely to panic and make poor decisions when things go wrong. He discusses practical ways to create room for error. Save more than you think you need. Avoid taking on too much debt. Diversify your investments. Don't assume good times will last forever. Be cautious with forecasts and predictions. Housel also notes that room for error gives you the freedom to take smart risks. When you have a cushion, you can handle setbacks without losing your footing. This allows you to be bold when it matters, but protected when things don't go as planned. He concludes the chapter by saying that the biggest difference between successful and unsuccessful people isn't necessarily skill or intelligence. It's the ability to survive mistakes and setbacks. Building room for error into every decision makes this possible. Quote to remember: "The most important part of every plan is planning on your plan, not going according to plan." Morgan Housel. Chapter 14. You'll change. Morgan Housel starts this chapter by acknowledging a truth that many people overlook. You will change. Your goals, values, and dreams about money are likely to shift over time, sometimes in ways you can't predict today. He explains that most financial plans are built on the assumption that our current desires will stay the same forever. But as Housel points out, we're constantly evolving. Long-term planning is harder than it seems because people's goals and desires change over time, he writes. This means that what feels important or urgent today might not matter as much in 10 or 20 years. Housel shares stories of people who spent years working toward a specific financial goal, a dream house, a certain career, early retirement, only to discover that their priorities changed once they got there. Some found happiness in places they never expected. Others realized they were chasing someone else's dream. He highlights research from psychology showing that people are poor at predicting how much they'll change. We assume our future self will want what our current self wants, but this is rarely true. Housel encourages readers to build flexibility into their financial plans so they can adapt as their lives and preferences shift. The chapter explores the dangers of being too rigid with your goals. Locking yourself into a path that doesn't allow for change can lead to disappointment or regret. Instead, Housel suggests focusing on general principles, like saving consistently or keeping debt low, rather than fixed targets. He also recommends approaching big decisions with humility, knowing that your future self may see things differently. It's wise to leave room for course corrections as you learn and grow. The chapter closes with reassurance. It's normal to change, and your financial plan should allow you to pivot if needed. The key is to recognize that change is part of life and to embrace it as you move forward. Quote to remember: long-term planning is harder than it seems because people's goals and desires change over time. Morgan Housel. If you're finding these insights helpful, don't forget to subscribe to Unbound Library and click the bell icon so you never miss the next chapter. Chapter 15. Nothing's free. Morgan Housel opens this chapter with a simple truth. Everything in life, especially in finance, has a price, even if that price isn't immediately obvious or paid in cash. He argues that understanding and accepting these hidden costs is essential for making good decisions with money. Housel explains that the price of investing success isn't always in dollars. Sometimes it's stress, volatility, uncertainty, or time. For example, earning high returns in the stock market means accepting periods of downturns and the anxiety that comes with them. Like everything else worthwhile, successful investing demands a price. But its currency is not dollars and cents. It's volatility, fear, doubt, uncertainty, and regret, Housel writes. He uses stories from history and personal finance to show how people often try to avoid paying these prices. Some jump in and out of investments at the wrong times to dodge volatility, only to miss out on long-term gains. Others chase quick wins or avoid opportunities because they fear short-term losses. Housel encourages readers to see these challenges as admission fees rather than fines. An admission fee is a cost you pay for the chance to get something valuable, like a ticket to a great experience. If you want the rewards of long-term investing, you have to be willing to endure the emotional ups and downs that come with it. He warns against the temptation to look for shortcuts or free gains. In reality, every opportunity comes with trade-offs and risks. When people refuse to pay the price by trying to avoid discomfort or uncertainty, they often end up with worse results. The chapter also explores how envy and impatience can make these costs feel even higher. Housel suggests accepting that every gain comes with a price, and the willingness to pay it is what separates successful investors from everyone else. He closes with practical advice. Before making any financial decision, ask yourself not just what the upside is, but also what price you'll have to pay, emotionally, psychologically, or otherwise, and if you're truly willing to pay it. Quote to remember, like everything else worthwhile, successful investing demands a price. But its currency is not dollars and cents. It's volatility, fear, doubt, uncertainty, and regret. Morgan Housel. Chapter 16, You and Me. Morgan Housel uses this chapter to highlight an important but often overlooked idea. Everyone's financial decisions make sense to them, but those decisions might not be right for you. Our backgrounds, goals, time horizons, and personalities are so different that copying someone else's strategy can lead to disappointment or risk. He explains that people tend to look at what others are doing, whether it's friends, family, or experts, and assume that those choices are the right way to handle money. But Housel points out, people do crazy things with money, but no one is crazy. What works for one person might be completely wrong for someone else. Housel illustrates this with the example of stock traders and long-term investors. A day trader might buy and sell stocks within hours, while a retiree might hold investments for decades. Both are acting rationally based on their own needs and time frames. Problems happen when people adopt strategies designed for someone else's circumstances. He also discusses how different experiences shape our attitudes about risk and opportunity. Someone who grew up during a recession may be cautious and value safety, while another person raised in boom times may be more optimistic and aggressive with investments. These differences are natural and should be respected. Housel warns against financial envy, the urge to compare yourself to others or chase results that aren't relevant to your own life. He writes, "What seems crazy to you might make sense to me." Trying to copy others can lead to stress, poor decisions, or even financial ruin if their goals and timelines don't match your reality. The key message is to focus on your own goals, values, and needs. Housel encourages readers to develop a personal financial plan that fits their unique situation rather than blindly following trends or advice meant for someone else. He closes the chapter with a reminder that the best financial decisions are those you can stick with through good times and bad, because they're tailored to who you are. Quote to remember, "What seems crazy to you might make sense to me." Morgan Housel. If you're finding these insights helpful, don't forget to subscribe to Unbound Library and click the bell icon so you never miss the next chapter. Chapter 17. The Seduction of Pessimism. Morgan Housel begins this chapter by examining why pessimism is often more compelling than optimism, especially in matters of money. He explains that bad news grabs our attention and feels more urgent than good news, even though progress and improvement are usually more common over the long run. Housel observes that people tend to take warnings and predictions of disaster more seriously than stories of hope or growth. Pessimism sounds smart. Optimism often sounds like a sales pitch, he writes. This is especially true with investing, where fears of market crashes or economic collapse can dominate headlines and influence decisions. He discusses how this bias toward pessimism can lead to missed opportunities. When people are constantly worried about what might go wrong, they may avoid investing, panic during downturns, or hold on to too much cash. Meanwhile, history shows that markets and economies generally recover and grow over time. Housel uses examples from history and personal finance to show that setbacks, like recessions or market crashes, do happen, but they are usually temporary. The long-term trend is almost always one of growth and improvement. Yet because pain from losses feels more intense than pleasure from gains, we pay more attention to negative news. He encourages readers to recognize this psychological tendency and not let fear drive their financial decisions. While it's wise to be cautious and prepared for risk, it's just as important to remember that progress is the norm, not the exception. Progress happens too slowly to notice, but setbacks happen too quickly to ignore, Housel notes. The chapter also explores why pessimistic predictions often sound more detailed and credible, even when they don't come true. Housel urges readers to balance caution with a belief in long-term growth. He ends the chapter with a practical reminder. Don't let short-term negativity blind you to the bigger picture. Stay focused on your goals, keep a balanced perspective, and remember that optimism, when grounded in reality, is a powerful force in building wealth over time. Quote to remember: pessimism sounds smart. Optimism often sounds like a sales pitch. Morgan Housel, Chapter 18. When You'll Believe Anything. Morgan Housel uses this chapter to explore why people often fall for financial myths, stories, and even scams. He explains that the way we interpret the world is shaped by our experiences, desires, and fears, making it easy to believe things that aren't true if they fit what we hope or worry about. Housel opens with the idea that everyone wants to make sense of a complex world. Money, in particular, is full of uncertainty and emotion. When faced with incomplete information or volatility, people naturally look for explanations, even if those explanations are too simple or not based in fact. He writes, everyone has an incomplete view of the world, but we form a complete narrative to fill in the gaps. This tendency can lead us to put faith in stories that sound good or offer comfort, especially during uncertain times. Housel provides examples of how this plays out in real life. People get drawn into market bubbles because they believe the crowd must know something they don't. Investors buy into sure things or hot tips because they want certainty and quick gains. Scams prey on people's hopes and fears, offering promises that are too good to be true. He points out that the financial industry often feeds into these tendencies by selling products or advice that sound appealing but aren't always realistic. The media also plays a role, amplifying dramatic stories and predictions that may not have substance behind them. Housel encourages readers to be aware of their own biases and to question stories that feel too perfect or too frightening. He suggests focusing on evidence, thinking long-term, and avoiding decisions made out of fear or greed. He also highlights the importance of humility. No one can predict the future with certainty, and it's dangerous to trust anyone who claims they can. The best approach is to stay skeptical of easy answers and remember that complexity is part of life. The chapter closes with a reminder: we're all vulnerable to believing what we want to hear, especially about money. Recognizing this can help protect us from mistakes, disappointment, and even fraud. Quote to remember: everyone has an incomplete view of the world, but we form a complete narrative to fill in the gaps. Morgan Housel. If you're finding these insights helpful, don't forget to subscribe to Unbound Library and click the bell icon so you never miss the next chapter. Chapter 19. All Together. Now, Morgan Housel uses this chapter to bring together the book's main lessons, showing how they connect and can be applied to real life. He emphasizes that the psychology of money is not about mastering a single strategy or rule, but about understanding a collection of timeless principles that work together. Housel starts by reminding us that every financial decision is personal and shaped by our unique values, goals, and circumstances. There is no one-size-fits-all approach, and what works for one person may not work for another. Still, some core ideas appear again and again throughout the book. Save consistently. Wealth is built less by striking it rich and more by saving over a long period. Respect compounding. Letting money grow through patience and discipline is more powerful than chasing high returns. Embrace humility and flexibility. The future is uncertain. It pays to plan for surprises and accept that you'll need to adapt as life changes. Focus on your own goals. Avoid being swayed by what others are doing or what the crowd says is right. Value freedom over status. True wealth isn't about impressing others. It's about the ability to control your time and choices. Accept risk and volatility. Money decisions always involve trade-offs. Don't expect rewards without paying the price of uncertainty and discomfort. Housel also revisits the importance of empathy. He encourages readers to avoid harshly judging the money choices of others. Everyone is shaped by their own experiences, biases, and challenges. He writes, "Financial success is not a hard science. It's a soft skill, where how you behave is more important than what you know." This idea runs through every chapter. What matters most is self-awareness, patience, and emotional control. The chapter wraps up with a call to action. Combine these lessons, apply them consistently, and focus on progress rather than perfection. Housel wants readers to leave with a sense of confidence and calm, not because they know all the answers, but because they understand the right questions to ask. He concludes that while money can be complicated on the surface, its most important truths are simple and timeless. By embracing these ideas, anyone can make better financial choices and build a life of security, freedom, and meaning. Quote to remember: financial success is not a hard science. It's a soft skill, where how you behave is more important than what you know. Morgan Housel. Chapter 20. Confessions. Morgan Housel closes The Psychology of Money with a deeply personal chapter, sharing his own beliefs, habits, and even mistakes when it comes to money. Rather than offering one-size-fits-all advice, Housel uses this chapter to reinforce the book's central message. Personal finance is personal, and self-awareness matters more than following someone else's formula. He opens with honesty, admitting he doesn't always make the mathematically optimal choices. Housel explains that he and his family keep 20% of their wealth in cash, not because it's the best way to maximize returns, but because it helps them sleep at night. We do it because it makes us feel more secure and calm, he writes. This echoes his belief that reasonable decisions are often better than strictly rational ones. Housel confesses to paying off his mortgage early, even when the numbers suggested investing the money elsewhere might yield higher returns. For him, eliminating debt provided a sense of freedom and peace that no spreadsheet could measure. He also shares that he avoids complicated investments and prefers simplicity. Housel invests in low-cost index funds and focuses on what he can control, saving consistently, living below his means, and not trying to outsmart the market. The author stresses that everyone must find their own balance between logic and emotion. What matters most is building a system that you can stick with during good times and bad. Housel writes, "My financial decisions are not right for everyone. They're right for me. That's the only goal." He encourages readers to reflect on their own experiences, values, and priorities. Instead of chasing perfection or copying others, find what works for you, even if it looks odd from the outside. The chapter ends with a message of acceptance and humility. No one gets everything right all the time, and that's okay. The goal is progress, not perfection. By being honest about your own needs and tendencies, you give yourself the best chance at long-term financial peace. Quote to remember: "My financial decisions are not right for everyone. They're right for me. That's the only goal." Morgan Housel. If you're finding these insights helpful, don't forget to subscribe to Unbound Library and click the bell icon so you never miss the next chapter. Key takeaways. Morgan Housel wraps up The Psychology of Money with a final reflection on what he's learned from years of writing, observing, and living through the ups and downs of finance. The epilogue brings together the book's themes, reminding readers that while money is complicated, our approach to it can be simple, thoughtful, and personal. Housel reiterates his core belief: how you behave matters more than what you know. Intelligence, technical skill, or access to information are not the deciding factors in financial success. Instead, qualities like patience, humility, self-awareness, and discipline make the biggest difference over time. He emphasizes that everyone's experience with money is unique, There is no universal formula for happiness or wealth. What works for one person might not work for another, and that's perfectly okay. Housel encourages us to focus on our own journey, learn from mistakes, and not judge others for their choices. One of the most important lessons Housel shares is about flexibility. Life changes, your priorities shift, and surprises are guaranteed. By building room for error and staying adaptable, you give yourself the best chance to thrive, no matter what the world throws at you. He urges readers to keep things simple. Spend less than you earn. Save consistently. Avoid unnecessary risk. Invest for the long term. Be kind to yourself and others when things don't go as planned. Housel's closing message is hopeful and practical. No one can predict the future or avoid every mistake. But by focusing on your values, practicing patience, and making decisions that help you sleep at night, you can create a life of security, opportunity, and freedom. He quotes his own lessons. Success is not a goal to reach or a finish line to cross. It is a system to improve, an endless process to refine. In other words, financial well-being isn't a destination. It's a lifelong journey of learning about yourself and making choices that support your happiness and peace of mind. Final key lessons from Morgan Housel's The Psychology of Money. Financial behavior beats financial knowledge. Your habits matter more than your IQ or expertise. No one's crazy. Everyone makes money decisions based on their own experiences. Luck and risk are always present. Be humble about your wins and compassionate about others' losses. Know what's enough. Don't risk what you need for what you don't. Compounding is powerful. Give your money and your skills time to grow. Focus on saving. It matters more than how much you earn or your investment returns. Room for error is essential. Prepare for things not going as planned. Your goals will change. Build flexibility into your financial life. Progress is quieter than setbacks. Stay optimistic. Good things take time. Personal finance is personal. Do what's right for you, even if it's different from what others do. Thank you for joining me on this journey through The Psychology of Money by Morgan Housel. I hope these insights help you think differently about money and empower you to make smarter decisions in your own life. If you enjoyed this summary, please show your support by subscribing to Unbound Library and tapping the bell icon so you're always updated with our latest book summaries and wisdom. Remember, the real power comes from applying what you learn. So keep growing, stay curious, and never stop investing in yourself. Until next time, take care and happy reading.